Welcome back to the Finder Investors channel. I'm Kylie, and in this video I'm going to be taking you through 5 investing mistakes beginners make that you should avoid. Just as a heads up, the information in this video is general in nature only. It is not financial advice. When you first start investing, you often get tons of information about what you should be doing, but not often what traps you should be avoiding. In my view, these 5 mistakes are the most common for investors that have just started trading shares, and they can seriously hurt profits or even end in losses. Stick around to the end of this video and I'll reveal what I think is the number 1 worst mistake you should avoid at all costs. Mistake number 5, picking the wrong online broker. So to buy shares, you need to sign up with a broker or trading platform. The only problem is if you pick the wrong broker, you can end up paying way too much in fees and be missing out on some really valuable tools that could help you to be a better investor. Depending on how often you trade, you could end up paying thousands of dollars a year more than you should be every year in fees. Before you start comparing, ask yourself, what kinds of stocks do you want to buy? Is it US, Australian, or global stocks? How often do you plan to trade? And how much are you planning to invest? These points will decide more than anything else what fees you'll be paying on different platforms. And the biggest fee here is the brokerage or commission fee. So that's the fee you're charged by your broker every time you make a trade. For example, let's say you make one trade in Apple stocks. Let's say broker X has a brokerage fee of $20, but then it has a bonus fee structure where if you make 50 trades or more in a month, that fee falls to just $10 per trade. And then on broker Y, you might find just the opposite. So say broker Y has a flat fee of $15 per trade. That's a better deal if you're only making a few trades a month, but if you're making 50 trades or more a month, you'd ultimately lose out. And the same goes for country brokerage fees. For example, broker X could charge $20 commission for, say, Australian stocks, but only $6 for US, and then the opposite again from broker Y. And of course, these days you have zero brokerage fee apps, mostly for US stocks. But it pays to remember that nothing is ever really free, and you're probably being charged more somewhere else, whether in foreign exchange fees or even inactivity fees, which is where you get charged if you don't make enough trades in a month. Plus, platforms with more features and trading tools also tend to have higher fees, so you'll need to balance what is most important. Like, for example, you might be happy paying a higher brokerage fee so long as you get broker recommendations or stock analysis tools. There are so many types of share trading platforms and online brokers out there today, so do your homework before settling on one. Mistake number 4, buying the news. Yes, it pays to be aware of what's happening in the news, but also be aware that news comes after the fact, and the market will have most likely reacted to the news before you can. So by the time you've read the news and come up with a plan, hedge funds will have already made their millions, and you'll only be supporting their business, not your own. That's not saying it isn't good to keep up to date and learn about the changes going on, especially when it comes to long-term trends, like maybe you want to invest in oil stocks because oil prices look set to rise, or there's ethical trends. But what is happening right now and what is hot shouldn't necessarily impact your short-term decision-making. If you're really interested in keeping up to date with company news, get to the original source and watch out for company updates. These are usually filed directly to the stock exchange or government commission. For example, there's the SEC in the US. Listed companies are legally obliged to publicly report any update that could impact their stock prices, good or bad. So in particular, you should keep a calendar record of when any company you care about publishes their annual and half-yearly revenue reports, which is when you get updates on company profits, debt levels, and future growth plans. If you use a stock portfolio app, you can keep a watch list of every company you care about and set an alert anytime an announcement is made. Just be aware that if you see it, so can every other investor. But if you're fast enough, you might get ahead of the curve. Who knows, maybe you're the person to first spot Tesla bought Bitcoin. So it can definitely be good to keep up with what's going on in the market, in particular your current holdings, but rarely does regular daily news give you an edge. Mistake to avoid number 3 is trying to time the market. It's not uncommon that new investors cling to the idea that they can time the market. Timing the market is the belief that we as investors can predict when the market will crash or go up. And there are a few reasons why this is difficult, if not impossible. Firstly, it's pretty impossible to predict the future. Not even the greatest investors of all time have crystal balls that enable them to see the exact timing of the next crash. And timing the market requires you to be correct, not only once, but twice. You need to sell at the right time, but you also need to buy again when you think the market has bottomed out. A good example would be the GFC market crash, where the market continued to fall for over a year. After such a long period of decline, a lot of investors grew wary and kept their money on the sidelines, even once the market began to climb again, ultimately missing out on the gain. So we can see how difficult it is to time the market when we zoom out on the stock market chart. On this scale, we can see that the market trends upwards more often than not. So parking your money on the sidelines means you miss out on the gains and the long-term upward trends of the market. Mistake to avoid number 2, buying penny stocks. A penny stock is a very small company stock that typically trades for less than $1. Now you might be thinking that stocks in this price range present a good buying opportunity because they're so cheap. But the reality is that the price of a stock doesn't actually reflect whether it's overvalued or undervalued. Penny stocks tend to have little or no profits and a very small market capitalization, which is the total value of all of their shares. On the other hand, companies with large market capitalizations are able to scale much more easily and they can raise large amounts of money. Penny stocks also tend to be highly volatile and can fluctuate wildly on a regular basis. This doesn't mean that penny stocks aren't worth the risk, but if you're a total beginner, it's probably better to avoid unless you've had a bit more experience. Unless you're prepared to lose what you've invested, in that case, yeah, go for gold. Penny stocks also tend to be illiquid compared to higher market cap stocks, which means it's going to be more difficult for you to sell at a price that you want because there are less buyers out there. And now we've reached number 1, the most critical mistake to avoid, not having a plan. If you don't have a plan, what are you trying to achieve? Having a clear plan and understanding of what you want to do and when is really important, because as great as investing in stocks can be, it can also be pretty risky, meaning you could lose your investment altogether. So before you invest, ask yourself, what do you want to achieve out of this? And can I afford to lose any of it? How long can my money stay in the stock market for? What will I do if prices start to fall? What about if prices rise? Say for example, you've just bought $5,000 in Apple stocks and 2 months later prices crash by 20%. Do you A, sell before prices can crash any further? B, buy up more Apple stocks? Or C, do nothing at all? Your answer will be based on what your overall investment goal is. If you can afford to keep money locked into the stock market for a few years, it's probably better to ride out the correction and even buy up more stocks if you're bullish on the company. If you can't afford to wait for many months or even years before you need to cash in the money, you probably shouldn't have invested in the stock in the first place. It might have been better to invest in a high interest savings account or an ETF. The stock market can also be an emotional roller coaster. So if you have a solid plan in place beforehand, you won't get drawn in to make brash decisions when you see prices suddenly crash or soar higher. Just remember that as your circumstances change, so will your investment plan, so it pays to review your plan on a semi-annual or annual basis. So that was the 5 mistakes total beginners should avoid when starting out. The easy part is identifying these mistakes. It's another issue to actually recognize them in yourself and deal with them. I would argue that all investors make some mistakes when starting out, and fair enough. Don't worry if you've made some of these mistakes, I certainly have. The important thing is that you come to an awareness of these mistakes and keep them in mind moving forward on your investment journey. Ultimately, it might be said that the biggest mistake of all is taking no action at all. That's it for today. I'd be interested in hearing any questions you might have in the comment section below. For those investors a little further down the path, what were some of the mistakes you made starting out that others might be able to learn from? If you've got something out of this video, please hit the like button and subscribe to stay in the loop for more content that's on the way. Thanks for watching, and we'll see you next time.